If you close your eyes and listen for the faint metallic resonance beneath the noise of history, you can almost hear it, the cold, unwavering heartbeat of gold guiding the rise and fall of nations. Long before economists argued in journals or traders stared at flickering screens, the world sought something immovable, something eternal, something that could anchor the chaos of commerce and the ambitions of governments. That anchor became gold, a metal so ancient it predates civilization itself, yet so mesmerizing that entire empires would tether their monetary fate to its glimmer. Whenever I immerse myself in the story of the gold standard, it feels less like examining a policy and more like watching humanity attempt to chain its anxieties to an element of the earth, hoping the solidity of metal could steady the storms of men. But gold's dominance was never inevitable. For most of human history, gold was an ornament, a symbol of power, a treasure locked in temples and royal vaults. It glittered in the crowns of kings, not in the pockets of merchants. Yet, as global trade expanded, something profound began to shift. Silver, once the workhorse of commerce, grew unstable in value due to uneven discoveries and shifting demand. And amid this volatility, gold, dense, rare, uncorroding, emerged as a silent candidate for monetary supremacy. Its beauty mattered less than its reliability. A merchant in London could trust that a gold sovereign carried the same weight and purity as one minted decades before. Trust, in finance, is the oxygen of progress, and gold breathed it effortlessly. As the 19th century dawned, the world found itself swept into unprecedented economic interconnection. Steamships shrank oceans. Telegraphs shrank time. Nations needed a monetary system that transcended borders, something universal, impartial, resistant to the political whims that so often warped paper currencies. Britain made the decisive move first, anchoring its pound sterling to gold in 1816. This was more than a financial reform, it was an imperial statement. By fixing its currency to gold, Britain broadcast stability, discipline, and predictability, and capital, like migratory birds sensing a shift in climate, flocked toward that stability. I often imagine standing inside the Bank of England in the mid-1800s, feeling the cool draft of stone corridors and the distant echo of footsteps as clerks moved through ledgers like surgeons navigating the arteries of global commerce. In those vaults, piles of gold bars sat as silent guarantors of trust, each ingot a promise that the paper circulating beyond the bank's walls was not illusion but representation. For every note, gold. For every obligation, an anchor. It is no exaggeration to say that the gold standard became the invisible skeleton holding together the global economy. Other nations followed Britain's model. By the late 1800s, an intricate, almost elegant machine had taken shape, a world monetary system in which currencies were exchangeable through fixed gold ratios, creating a seamless network of predictable exchange rates. A merchant in Paris could transact with a banker in New York without worrying about currency collapse. An investor in Berlin could deploy capital in Buenos Aires, confident that gold parity offered protection from runaway inflation. Finance, for a rare moment in history, felt orderly, and this sense of order allowed global trade and investment to swell like a rising tide. Yet beneath this elegance lay fragility, a fragility born from a system that demanded nations sacrifice flexibility for credibility. Governments operating under the gold standard had to prioritize the metal above all else. Balance of payments deficits required painful corrections, raising interest rates, squeezing credit, tightening the economy until gold flowed back in. Imagine the tension, leaders facing unemployment, social unrest, falling wages, yet choosing austerity to defend an abstract conversion rate between paper and metal. The gold standard was a stern tutor, demanding discipline even when the human cost grew unbearable. Still, throughout the 19th century, the system held, until the world changed. When World War I erupted in 1914, nations discovered that cannons and trenches could not be financed with the slow discipline of gold-backed spending. Governments suspended convertibility, printing money to feed the machinery of war. Gold fled into private hoards like animals sensing a storm, and just like that, the global monetary anchor cracked. The world tried to restore it in the 1,920 seconds, a restoration I often imagine as a tragic attempt to resurrect a ghost. The pre-war world, with its stable flows of capital and its confidence in gold's immutability, was gone. But policymakers, haunted by nostalgia for the order gold had once provided, clung to the illusion that it could be revived. Britain returned to gold in 1925 at an overvalued exchange rate, a decision Winston Churchill later regretted deeply. The economy groaned under the weight of deflationary pressure. Workers paid the price. Nations that joined Britain in re-embracing gold discovered that the discipline required now bordered on economic self-harm. In truth, the world was demanding liquidity, adaptation, and flexibility qualities gold could never provide. And then came the Great Depression. Bank failures swept across continents like wildfire. Prices collapsed, unemployment soared. In this moment of desperation, gold revealed its harshest flaw. It made crises deeper. Countries bound to gold could not expand money supply or ease credit without losing their gold reserves, so they sank deeper and deeper into contraction. Meanwhile, nations that abandoned the gold standard earlier, Britain in 1931, the United States in 1933, began recovering sooner. The chain to gold, once a symbol of stability, was now a shackle dragging economies underwater. When I think of the gold standard's fall, I think of it not as a failure but as an ending, a natural conclusion to an era where the world believed certainty could be mined from the earth. The truth was more complex. Gold had been a magnificent stabilizer in an age of limited democracy, slow capital flows, and rigid social structures. But the 20th century was none of those things. It was fast, volatile, democratic, global. A rigid anchor could not hold in such unrest. Yet, the story of gold did not die with the Depression. It transformed. The post-World War II Bretton Woods system revived gold not as a universal anchor, but as a reference point, tying the U.S. dollar to gold and other currencies to the dollar. For a time, it seemed the world had found a balance between discipline and flexibility. But even this hybrid arrangement began to strain as the U.S. printed more dollars than its gold reserves could support. By 1971, the illusion broke. Convertibility ended. Gold was dethroned. And yet, gold never lost its mythic gravity. Even today, central banks hoard it, markets watch it, investors treat it as a barometer of fear. The gold standard may be gone, but its psychological imprint remains etched into the architecture of finance because the story of gold is ultimately the story of humanity's search for certainty in a world shaped endlessly by uncertainty, and that search will always continue shaping the psychology of markets long after gold ceased to shape their mechanics. For even without a gold standard, the allure of an immutable anchor lingers in the human mind, a yearning for something that cannot be printed, manipulated, or erased by political winds. In this way, the ghost of the gold standard still walks beside us, influencing debates, swaying investors, and whispering reminders of an age when nations believed stability could be forged from metal. As we follow that ghost into the modern era, we see its imprint everywhere. Consider the decades after 1971, when the world plunged fully into fiat currency, a system backed not by gold, but by trust in governments and central banks. In theory, this newfound flexibility liberated nations. They could respond to recessions with stimulus, adjust money supply according to economic needs, and escape the deflationary grip that had haunted the interwar period. But flexibility came with temptations. Without gold as a constraint, governments discovered the political seduction of deficit spending. Central banks learned they could become the guardians of entire economies, tasked with taming inflation while supporting growth, an impossible balance that would repeatedly test their credibility. Still, even as money became untethered, gold's role as a psychological anchor only deepened. In moments of crisis, oil shocks, inflationary spirals, geopolitical fractures, the price of gold surged, revealing something profound. When trust falters in the architects of fiat currency, people instinctively reach back to the metal that once defined certainty. In the late 1970 seconds, as inflation roared across the United States and faith in paper money buckled, gold soared to unprecedented heights. It was as if the world were reaching out in desperation to an old compass, trying to regain direction in a storm modern finance had unleashed. Yet, the gold standard's true legacy is not price movement. It is a philosophical divide that shapes every major economic debate of our time. On one side are those who long for the discipline gold once enforced, arguing that fiat money untethered from scarcity invites recklessness. On the other are those who see the gold standard as a relic too rigid for a complex, interconnected world. This tension surfaces each time inflation rises, each time central banks expand their balance sheets, each time debt climbs to new heights. Beneath these arguments lies a deeper question, one whispered through centuries. Should money be governed by nature's limits or human judgment? But the story continues to evolve. In the 21st century, new contenders have emerged: digital currencies, decentralized ledgers, cryptographic scarcity. Bitcoin, often called digital gold, was born from a distrust of fiat governance, echoing the same fears that once fueled devotion to the gold standard. Its code enforces scarcity with the same ruthlessness gold once enforced discipline. Its believers see in it the resurrection of something lost, a monetary anchor immune to political manipulation. Whether this proves visionary or misguided remains uncertain, but it demonstrates that the search for stable, incorruptible value remains alive, as persistent as the human longing for order amidst uncertainty. Central banks, too, have not fully escaped gold's gravitational pull. Despite the end of convertibility, nations continue amassing gold reserves: China, Russia, India, treating the metal as strategic insurance against a future where fiat confidence might fracture. Gold remains, silently, in vaults beneath cities, untouched yet never forgotten. And as global tensions rise, as currencies fluctuate, as debt crescendos, the metal's symbolic weight grows heavier. Gold no longer anchors currencies, but it anchors fear, and fear is one of the strongest currencies of all. Yet perhaps the greatest legacy of the gold standard is the clarity it offered. Under gold, governments were constrained, markets understood the rules, currencies carried discipline as their genetic code. In abandoning gold, the world traded that rigidity for adaptability. This was not a mistake, it was an evolution. But evolution always brings consequences. When I look at the modern financial system, its labyrinthine complexity, its reliance on confidence rather than convertibility, I cannot help but sense the echo of gold, reminding us that systems untethered must find new anchors, new forms of credibility, or risk drifting into instability. And so the story comes full circle. The gold standard may be gone, but the desire behind it, the yearning for a reliable foundation, remains the quiet engine of monetary history. Whether through gold, digital scarcity, central bank frameworks, or future innovations yet unimagined, humanity will always search for something that steadies the pulse of commerce. Because the deeper truth is this: money is not merely a tool, but a promise. And every society must decide what guarantees that promise: metal, mathematics, or faith. As we reflect on the era when gold ruled the financial world, we see not just a monetary system, but a mirror reflecting the fears and aspirations of entire civilizations. Gold gave structure to uncertainty, discipline to ambition, and order to chaos. And even in its absence, we continue to build financial architecture in its shadow, guided by its lessons and haunted by its losses. The gold standard did not end. It transformed into a memory that still shapes decisions in boardrooms, trading floors, and central bank meetings. A reminder that stability is never free, discipline never painless, and trust never permanent. If this journey through the age of gold awakened questions or curiosities, share what struck you most, what moment felt closest, what lesson felt sharpest. And if you want more stories where the past illuminates the financial present, follow the channel so you never miss the next turn in this long, cinematic saga of money.